Hey guys, welcome to this week's Money and Investing Show. This week we are looking in the rearview mirror. That's right, we're looking back over 2022 at some of the major discussion points through the year, how perhaps they've created opportunity and how they've wrong-footed people at the same time. Plenty to take out of this. I'm sure you'll be coming up for air at the end of it because it's been one heck of a year and certainly plenty to digest, so enjoy the show. Hey guys, welcome to this week's Money and Investing Show with me, your host, Andrew Baxter, and as always, my offsider and co-host, Mitchell Renshaw.
Thank you for having me on the show, Mr. Baxter. And jumping straight into things today, I'm really excited about today's episode. This is our famous Year in Review podcast. We do these every year. Here we are at the end of Season 3, the 2022 Year in Review.
What a year it's been. It's hard to believe that, we really are at the finish line for the year. And when you look back at some of the tumultuous events in 2022, it's definitely one for the books. Every year feels like it brings with it its own story, but this year has just been a bit of everything. It's been a mammoth production, that's for sure.
I can only imagine when we get to say season 10 or 12, we're going to look back at our season 1, 2, and 3 year in reviews, and it's just going to be like, wow, that was just crazy. And this year is no exception to that.
You won't have very many years in your trading and investing career that will carry with it the uncertainty, the volatility, and the number of factors, macroeconomic factors especially, that have come along and knocked forecasts, outlooks, and strategies into touch, and taken you from looking like a hero to a fool and back in 30 seconds flat. It's just been an incredible year. So let's dive into the matter. What do you got? I mean, we all look a year older, I'm sure, probably a year more handsome and fitter nonetheless, and certainly a year healthier and wealthier. But what have we got for the year?
I think the big obvious one in here, the elephant in the room, is the war, Ukraine and Russia.
That's right. Well, we saw that kick off in February, and it was really interesting. At the back end of last year, I think around about November time, we were starting to get quite interested in energy prices, and that came through in spades as a very rewarding trade when Russia invaded Ukraine, and that war is still ongoing now. I think most people, myself included, probably expected that to be sort of wrapped up and done and dusted in 5 minutes, and in reality, here we are, and it's testimony to the fortitude of the Ukrainians and obviously some of the help they've had from the West in terms of thwarting Russia's attempts. But we're sat here, through the Christmas period, and there are people, millions and millions of people without power, without water, and freezing. It's almost hard to believe that we see that in the 21st century. But an old-fashioned war, a very nasty war, and one that perhaps when we look back with hindsight might be an unnecessary one too.
Absolutely, and I think the investment opportunities that a lot of our investors drew from this was the commodities market, particularly oil and natural gas.
Oil and natural gas were two big plays on there. Also, we had a good dabble in the grains. A lot of speculation given, what a massive exporter of commodities like grain commodities that the Ukraine is. We saw a big surge in wheat that came off the boil through the year as the reality that the world's population wasn't going to be starved to death. There were going to be trade agreements held in play, and exports did happen, but certainly wheat and corn were also quite a nice little run there in those two ETFs, WEAT and CORN, corn being two of the ETFs that profited very well from that. Harrowing as it is, our job isn't to sit here with a moral compass. It's to provide investment opportunities for our clients, and there are four, being oil, natural gas, wheat, and corn that came directly out of that invasion of the Ukraine, and hopefully that's something that does get resolved sooner rather than later for the sake of humankind.
Well, speaking of which, and let's keep this maybe on a political sort of mandate whilst we're chatting about this now. We chat about China and Taiwan and the issues that have been going on there. Yeah,
look, that again, I think once the world sort of sat back and has allowed Russia to go about what it's done in the Ukraine, albeit with some fairly harsh economic sanctions, but at the same time with a reasonable level of impunity when you've got people dying from their town, schools, hospitals and buildings that they live in being hit with missiles. It does look like to an extent the West has sat back, and I think China has seized on that opportunity insofar as, it's okay for Russia to have a crack at the Ukraine. We might go full steam ahead into Taiwan, and I guess some fairly firm words from President Biden in the US has made it pretty clear that is something that would involve the US getting engaged in a conflict. So that hasn't happened, fortunately for the world. But nonetheless, from a geopolitical perspective, and looking at China's expansion policies throughout the South China Seas and beyond, there is a heck of a land grab going on right now. And whilst all of this is going on, the West's focus is on that, and we're dealing with some fairly tough economic conditions. And meanwhile, India's sat back and just got on with growing its economy quite nicely under the radar till we just published it now.
Indeed, we did. Now, changing pace, AB, because we've got a lot to cover in this review. Let's talk about, interest rates and inflation. It's really been the talk of the town this year.
Certainly has been. I mean, we've seen levels of inflation that haven't been witnessed for an awful long time. 7-8% in the US and Australia as the two benchmarks, over 11% in the UK, and it's been an awful long time since we've seen anything really like that. And for the majority of people that are investors and going about their daily business, they've never seen it and haven't reacted well to the fact that there's a huge pinch on the cost of living. And it's not necessarily sitting high on the hog, just everyday stuff, filling your car up with fuel, should I say, filling the grocery trolley with food. It's all more expensive than people can really deal with at a time when the margins for living between wage growth and the general costs has been shrinking at a rate of knots. Affordability in the property market being a big factor there too. Has seen a lot of people really struggle massively financially and put themselves under incredible duress, and it's not fun. It's a diminishing quality of life economically, and that's not what people really dream about. I guess in terms of interest rates, it's been a tale of two very, very different halves insofar as the way the US has handled things versus that we've seen here in Australia. So, hats off to Jerome Powell, the chair of the FOMC and Fed Reserve in the US. He's been extraordinarily clear in his communication with markets. He's also been, admittedly, they got to the party a little bit late, but they've played catch up quite well with some fairly aggressive direct interest rate moves that have taken US rates up to that sort of low to medium fours, which is unprecedented considering it's 0.1% not that long ago. And it appears to have started to work in that inflation is slowing down, and I think we're probably going to see peak interest rates probably January, February in 2023. But they've done a pretty good job. But more than being aggressive with the medicine, they've been extremely good at communicating it. Now, by contrast, if we look at that here in Australia, it would be a year in review if I didn't talk about Philip Lowe, or Dr. Philip Lowe, should we say, and how poorly the Australian Reserve Bank have really operated insofar as not only have the measures they've taken been probably a little bit too light, but their ability to communicate with markets, and not just with markets, but with the Australian public, have been woeful. There should never be comments that are open to misinterpretation. And when you see how emphatic the Reserve Bank were, there will be no interest rate rises until 2024 at the earliest, and they reiterated that at a separate presentation. There's no room to misinterpret that. There's no, you didn't pick up on the micro signal of me scratching my left earlobe when I said it. It was made it very, very clear. And the flip side to that is that it's resulted in a lot of everyday people, on the basis that they were told not to worry about interest rates for a couple of years, have probably borrowed more than they'd be comfortable borrowing to get into an overheated property market. And now, of course, with interest rates moving up in the way that they have, they've got to now find, $800 to $1,500 a month extra to service a more expensive mortgage. And it's caused massive, massive damage. And it's very unfortunate because it was avoidable with better communication.
Couldn't agree more. And I guess let's talk about maybe the property market in a little bit more detail, AB. Prices have come down this year, or in the latter parts of this year. We've seen auction clearing rates fall away as well. What are your thoughts there in terms of how to recap that for the year?
I think, the property market has been very made up of a lot of different pockets. So if you take, for example, Melbourne and Victoria, it's probably been one of the weaker areas insofar as property prices are concerned, and probably not that hard to understand given how stringent the lockdowns were during the pandemic. Even harder to fathom that they managed to re-elect Dan Andrews as their premier.
How can we forget?
But it's happened. Never underestimate people. Anyway, I won't even finish that that quote. No, we won't. We'll leave that one in. This is a look back on the year, and it's bizarre, but there you go. People get what they vote for. But the migration that we've seen out of that state elsewhere has supported property prices. Queensland's been relatively defensive. My neck of the woods in the Northern Rivers, Byron Bay area has also been pretty resilient. And yes, prices have lost that FOMO, that charge at auction, and clearance rates have slowed down a little bit in a lot of the cities. But I think there's still been quite a reasonable price achieved in some states in that property space. I think that's going to change quite dramatically with higher interest rates. But we're also in a situation here in Australia where investors have been very aggressive through the property market, particularly when interest rates were quite low. And that's resulted in a lot of stock being taken out of the market is in the renting pool, and particularly in short-term renting, your Airbnbs versus available for longer-term tenancy, which has served to push up rents really quite substantially. So it's created a real pain point, if you will, for renters, which is unfortunate. But they're the commercial forces at play here, where the people that do own property, and given the holding costs of that property have increased considerably with higher interest rates, like any business, they're going to pass that cost on to the end user, which in this case has prompted higher rents for people that are in the rental space. It's
tough out there. The consumers really struggled this year, no doubt.
Very, very tough. And is it opportunistic on their part? Is it exploiting the market, or is it just a pure factor of market forces that unfortunately are market forces? Supply and demand are what dictate price, and that's left people in a very, very difficult situation from a rental perspective, for sure.
Got it.
Add to that slowdown in the construction side too. We've seen this year, a significant number of builders go under, from some fairly high profile companies, ProBuild, Condev, for example. At one point in time there was talk of Metricon going, but they managed to shore up their balance sheet with some urgent finance from some of the big stakeholders in that business. But I think more than anything, that's exposed the very, very thin market margins that the property industry has been operating on, and with costs increasing, as everyone's seen across building materials, as costs increase with high levels of wages and higher interest rates for funding debt, it's made it very, very difficult for those companies to survive. So we've seen a fair slug of them go under. Also has called into question the way that insurance works in the property market, because, for example, in New South Wales, the state underwrites the construction of your property from an insurance perspective, yet in every other business you have to have professional indemnity insurance that you pay for yourself. So they've managed to lay off the risk in construction and push it onto the taxpayer and the state, as opposed to absorbing it personally or within the company, which is probably how it should be.
Totally, that's really backwards and really bizarre. Speaking of which, and I think this is probably...
There's a lot of things this year that have been backwards.
I've got a long list in my brain that I want to run through. This is the third time we've spoken of this, and it's kind of the forbidden word at the moment, but we're going to have to say it. That's COVID, AB, this year.
Yeah, it's reared its head again. We're sitting on the hopefully something that's not going to be too damaging, but certainly in China we saw lockdowns occur once again, and China's starting to come to the reality, I think, that zero COVID isn't a policy that is effective and really realistic. I've seen the drama it's caused at Foxconn, Apple's plant, and there'll be big knock-on effects for Apple there as they fail to be able to meet demand for their product because their factory's shut. It's going to be very interesting to see how China deals with this. There are obviously cultural issues there, and it's a huge generalization, but particularly in Asian culture, changing direction and admitting you're wrong or losing that a loss of face is arguably one of the biggest insults that you can have. And so you can understand why the government have been fairly resolute on it, because that 180 turn is just unfathomable from a cultural perspective. But yet, in terms of the practicalities, is probably what needs to happen. So it'll be interesting to see how that one plays out. Having spent some time in Italy through the middle of the year, it was actually really interesting to spend time in a place where no one is dominated by headlines like COVID. And I think, they had such a huge mortality rate at the very outset of the pandemic that anyone that was likely to die has probably passed away, unfortunately, and so they're getting on with life there. And it was quite refreshing actually to be in that environment. But yeah, it's that acronym that just keeps coming back, and
it does.
Might dominate next year's conversation too, depending on how, of course, it impacts on money and investing.
Indeed. Well, let's hope not. Changing pace now, what about our good old friend Elon Musk and Twitter? How could we forget this year?
Yeah, look, I mean, it was the deal that was done and then wasn't done, and he tried to wheedle out of it, and then it called into question the veracity of the subscriber numbers on Twitter, which, to be fair, as a business that operates in the social media space, we're pretty skeptical about some of the policies that social media providers operate in terms of their subscriber numbers and things like that. Be careful what we say about it. But the reality is, Twitter probably didn't have as many people as he thought he was buying. He tried to get out of the transaction, couldn't do it, so he's ended up buying it anyway. And it'll be very interesting to see how Twitter 2 comes back. At the moment, there's a lot of negative PR. And look, hats off to the guy. The reason he's the richest guy in the world is not money motivated. It's a byproduct of his vision for how he sees the world, whether that be through early investments in things like PayPal, or whether it be through Tesla or SpaceX, or you look at Starlink now in terms of the internet service and what they're looking to be able to do with that. It's someone that's a pure visionary, and walking into a business where you're expected to provide lunch for your employees, but everyone's working from home. So you go, okay, well, we'll stop providing lunch. And yet there's a backlash going, oh, you can't stop providing lunch. It's like $400 per employee to provide lunch. What are you talking about? It makes no commercial sense.
Got it.
It's quite interesting, and it'll be very, very interesting to see what the reemergence of Twitter comes back. His view is, I think, that he wants it to be the global town square where there is a level of freedom of speech that's not too censored, as we've seen with some of the high publicity bannings on Twitter. Obviously Donald Trump being one of them.
Took the words right out of my mouth.
And it's like, well, if you're providing a platform for freedom of speech, then it's exactly that. It's a platform for freedom of speech. The flip side is, there has to be a filter of some sort if people are there, that are hate spreaders and doing bad things, in which case takes away their right to freedom of speech. It's a very tricky one. Glad it's not my decision to call it, but there's a good chance that Twitter Mark II it's got the potential to be everything and more that it really should be. And you've got someone that's got the financial backing in order to make that a reality, that's for sure. Certainly got the vision for it. And now I think he's got a real bee in his bonnet. He'll deliver. But it's just been interesting to see the media's dealing of that acquisition. And I guess you give people good fodder when you dismiss people via email. I guess they're all working from home. You can't call them into the office if they're not there. You'd have to buy them lunch if you did that.
$400 a person.
$400 a person. So it'll be very, very interesting to see what happens. But he's someone that's redlines his business in terms of employee commitment, and the employees are rewarded handsomely. So if you're in there and you're part of the future as opposed to the past, then I think the little blue bird, if it ends up still being the little blue bird, is going to be a good place to be. And if you're not and you want to be part of the old guard, well, I think that's been well and truly turned off.
Well, sort of diving on the topic of free speech, we spoke about Donald Trump just quickly there. How can we forget US midterm elections this year and a rerun?
Segue. Your segues this year have just got better and better.
See, it's when I've got all these lists playing in my head, AB, it's just rolls off the tongue. And Donald Trump, how could we forget?
Of course. So the midterm. So we saw the Republicans regain control, and I think a split system creates quite a logjam in terms of legislation, which, to be fair, depending on your political allegiances, could be a good thing or not so good thing, depending on how you see it.
Good for stock markets, though, right?
Potentially, yeah. I mean, the Republicans have played the debt ceiling card a few times as leverage in this situation. But looking at some of the policies at play that the Democrats have put forward, you've had the Inflation Reduction Act. It's a nothing. It's a politically motivated, nothing achieving act in the near term. And if you're Joe Bag of Donuts living in America week to week, trying to make ends meet, the fact that act will have absolutely no impact on your life for at least 10 to 15 years doesn't resolve the immediate problem. And it's cheap politics when you start doing that sort of stuff. But we've seen a shift there, and I don't think here's an outlook for not for next year, but the year after. I don't think we're going to see a second coming of Donald Trump as president on a basis of age, probably legal challenges, but more importantly, I think a more appropriately qualified candidate will be in the hot seat, and I suspect Ron DeSantis will be the next president of the United States.
There we go.
Yeah, I mean, you look at the last series of elections. If Joe Biden and Donald Trump are the best two you can offer up, it's a very, very sad state of affairs. Someone like Ron DeSantis, who's younger and pretty well qualified, I think, for that role. Has got all the hallmarks of a great future president, and I think it would be good for America to have somebody that's maybe a little less extreme in that role, where they perhaps think a little bit more about the sound bites coming out of their mouth, but also back it up with action.
Okay, well, diving deeper into the topic, another segue here for you into some disconnect and some issues. Change of pace here, economic data this year. I mean, there's been a huge disconnect between what the data says, what markets have done, and what people have actually felt and reacted to. So 2022, how would you sum it up, AB?
I'd say this has been the hardest year I can remember personally for me in markets to have a really direct and accurate bead in terms of the reality of what's happened versus what should be happening.
And that's 30 years experience, the hardest year you've had in 30.
Hardest year by a margin.
That's crazy.
We used to publish a book called Outrageous Market Predictions, which we used to put out this time of year, and I guess the podcast has usurped that. Why do I say that? Well, if you look at all the economic data versus what's gone on, so take housing starts, for example, which have been in a decline. We've seen interest rates moving higher. The demand for new houses has slowed because to move, you've got to refinance. In the US, a lot of people on 30-year fixed mortgages with 2% or less as their interest payment. You refinance now at 7%. It's not very attractive. So housing starts have been declining, slow. And then this month, on the back of a 0.75% increase in interest rates and a continuation of the trend down, comes out with a better than expected figure. And you'd have
Crazy.
all money taking the other side of that trade. Just one example. But looking at consumer confidence, which has been pretty resilient. And I think one thing I'd say this year, the US economy has been incredibly resilient, more resilient, I think, than anyone would have expected in the face of, some fairly tough fiscal policy interest rate moves that we've seen, which, given how aggressive they've been implemented, should have really pulled things up pretty quick smart. Just looking at the Black Friday / Cyber Monday / Thanksgiving weekend, three different sort of focus points all in the same weekend for shopping. And it was a record weekend for sales, albeit online, but just absolutely astronomical. And for all money, you would bet that wouldn't be the case as people batten down the hatches and struggle to make ends meet, given the rampant cost of living. Having been in the US earlier in the year, and a couple of things out of that trip. Number one, obviously the level of homelessness was just even more epidemic than normal. But number two was that pain point that was almost universal everywhere, was how expensive everything was and that people were really struggling financially. Yet you look at a Black Friday, Cyber Monday sales weekend and it's gone ballistic. I think the longer term consequence of that are going to be quite different in that there may have been a large volume of sales, but the discount levels that retailers were having to apply was really quite strong. And that'll come home to roost, I suspect, when we get into the next earnings season. We go, look, we had great sales volume, but the margin we made out of that was compromised and was actually reasonably thin. And to that point, you look at, say, something like Walmart, for example, which, the world's biggest retailer and has got rising levels of inventory far higher than what its sales are growing at. So you're going to see that inventory go in the discount hopper at some point too. So I'm expecting, whilst the data has been reasonably strong, certainly stronger than you'd expect over the back end of this year, I think the consequences are still going to be felt in earnings in the first quarter. We got that wrong. We expected to see that this side of Christmas. I think we'll still see it after Christmas as companies come to terms with those higher costs and more discount needed in order to maintain market share.
There's a lot in there. And as you mentioned, it's been a really challenging year.
There's another disconnect for you. We've had rampant inflation, but we haven't really seen much of a move in gold other than over the last few weeks.
That's true.
So once again, and this one is probably worth talking to in that, your average investor, when you speak to them, and we see this on social all the time, we talk about our game plan against inflation or buy gold, but it's actually been a woeful play over the last 3 years in that respect, other than the last couple of weeks. And why is that? There's another disconnect that you'd normally expect to see happen. And how do you go to bag of tricks as an economist? It hasn't worked.
It's been a weird year, and I think when we think about it and chat about it, it is a really challenging year when you think about it. So are there anything that Any other things that you can think of? I think I'm out of...
New government here in Australia.
New government, that's right.
Yeah. It's been interesting to see, I think for the first sort of month and a half, Albanese did a pretty reasonable job of trying to galvanise the country after what was a pretty average previous government. But the wheels are starting to crack there, and I think for Australia, as a country that kind of prides itself on being progressive in terms of its thought process, there are a lot of regressive things going on right now, and probably the and this is not a political dig at all. You look at the changes that Labor have tried to push through from an industrial reform perspective. Normally, industrial relations acts take quite some time. They go through quite a considered process in order to be well considered by all stakeholders. We had the job summit that happened not too long after the election, which created a level of vibrancy and optimism, I think, in business, where you had a very much a consultative type environment between government and employers and employee representation to try and work on what Australia looks like as we continue to be progressive and move forward. And we've got the Fair Work Act already, which actually, as its name would suggest, a Fair Work Act. But those changes to industrial relations, where the use of collective bargaining, so if you're in a particular industry now, and they've tried to change who's involved to try and remove a lot of small business from this, which is a good thing. But if you're involved in a particular industry, there's going to be an industry award based on collective bargaining, which is a return to union power. And unions represent less than 10% of the workforce in Australia these days because we're a progressive country, and yet we're trying to bring the power of the unions really back straight in the guts of what's going on. And that's a major step back, because as an employer, it makes life very, very hard to run your business and reward people properly. If you've got overachievers, they should be rewarded well. If you've got underachievers, they give them the help that they need to get on point. And if they're not unable to be helped, then I guess the next thing is a rehab out the door to somewhere where the culture might be a better fit. And harsh as that may sound, you want to, as an employer, create an environment where everyone can thrive and earn what they need to, as opposed to what you're mandated to pay somebody. And that's not to underpay people, it's so you can overpay people. Reward success, and that's what progressive should be. And I think that, plus some of the tax reforms that we're starting to see, is a real step back for Australia in terms of where we may be, and that will have impacts from a foreign investment perspective, but it also massively impacts on business confidence. And we've spoken in this podcast this year about the number of people that are employed by small business. Business confidence is so important to keep the wheels of our economy turning. And people may argue, well, it's not just about money. It's not just about the economy, it's about people. Yes, that's very true. And the more the wheels of the economy turn and the more money people make, the more tax they pay to support those that need help. When you slow the train down, everybody suffers, because there's less cash to go around to help those people that perhaps are on welfare or need some form of social security. And whilst I may come across as being a little more right-wing in what my views perhaps are, having spent some time again in the US, as I've spent years in the US now, but earlier this year probably highlighted more than anything how important it is to have a very fair and resourced social security system to help people when they really need it. When you see hundreds of thousands of people living on the street, that's not such a good thing. And there needs to be something put in play to help those people. That said, on the other side of the equation, we're looking in Australia at such strong job numbers right now, yet we've got more people claiming benefit than before the pandemic, and that can't be right either. We need people to work. It's not a choice, it's an obligation as a functioning member of society to do that. And I think, in our attempts to be maybe a little bit progressive, or more progressive than is healthy, we've kind of lost sight of the fact that people need to be contributing members of society, not just because of financials, but to give people a purpose and to have a level of inclusion. We talk about being in a more inclusive society, so why don't we include people in the workforce?
Another big disconnect, or a number of them there that you mentioned, AB.
Hugely in that regard, for sure, yeah. So, looking back on the year, it's just been crazy, truly.
We should get our listeners out there, if you're listening to this right now, comment below the moment or the event or whatever it was that stood out to you most. I'd be really interested to hear if there's something that we've missed today, AB, or really what stood out to our listeners.
Here's another one for you. Buy now, pay later. We've talked about this previously.
We have to talk about it.
Buy now, paying later.
Yep.
Here's a reframe. So here was something that was a market darling a few years ago, and I think it's coming home to roost now, as per our previous comments, that, it probably wasn't the knight in shining armor that it looked to be. And again, there are so many subsets that you can drop in and evaluate. We've got a market overall that most people would describe as being very volatile. Yet if we look at the measure of volatility, the VIX index, or VIXI or UVXY, which are some of the ETFs that we trade off, that they're at below year low levels right now. They're all-time lows for the year, in a market that most people are suggesting is pretty volatile. So there's another disconnect between the measure of volatility and how it truly feels, and that, I think, just sums up the year. The right and left hand aren't clapping.
Absolutely. Well, let's wrap it up there, AB. That's a good way to finish 2022 year in review. We're going to edge into season 4.
Yeah, congratulations, man.
Congratulations.
I know when we started this, a lot of you're never going to do weekly. We'll always find something to talk about. I don't know what your feedback is as a listener as to what we talk about. But here we are concluding, putting this one in the tin for season 3. So massive congratulations for bringing your personality and line of inquiry into this to try and get more out of me. And big gold star for you for your segues this year. They've improved. They were coming from a very modest base, but they're
any improvement's better than no improvement, right?
They're getting pretty good now. So it's great to be sitting here at the end of season 3, and more importantly, looking forward to some of the great guests that we know we've got lined up for season 4 and beyond. Plus a new studio, I believe. The
Can't wait.
powers that be have got the checkbook out, so we might find ourselves in a even more salubrious set of circumstances to talk to this stuff.
Can't wait. Well, Merry Christmas, AB. Thank you to our listeners out there for tuning in. And should we go and grab a beer?
Sounds like a wonderful idea.
Done. Let's do it.
Mitch. There you have it, guys. Make sure you give us a review and a rating. More importantly, we look forward to hosting you as we move into season 4 of the Money and Investing Show next year. Speak then.